Um, okay, cool. So I'm going to do this. Bear with me. This is the first time. We'll probably do a number of these before we get it right. We're going to talk about delta, gamma, and theta. And when we do this, I'm going to experiment with drawing on the board. And of course, it's a virtual board. So we're going to try to share a whiteboard and go over some basic material. We will invite you guys to ask questions in the Q&A as well. And even though I have some help, this is our first time, so just bear with us. Relatively recent entrant. Okay, cool. So if you're in the Discord, this stuff should be mostly familiar. Obviously, we're going to come at this from a pretty low level right now. This is supposed to be formative, right? So everything we talk about will be relevant when you think about dealer hedging dynamics, but this is kind of from the square one. So um, the first thing that you guys should all know about, obviously, is delta, right? So can you guys see the whiteboard? Should be whiteboard plus camera. I'm not really exactly sure how this works. Okay, cool. That's pretty smooth. Okay, I like it. Both camera and whiteboard. Okay. Ideally, it's like my head against the whiteboard, but you guys have to deal with the palm trees for now. So this graph here, delta versus spot price. Gosh, I would love to have like actual panelists who could speak back to me, but I like that you guys are active in the chat. Can anybody tell me what's wrong with this graph? If you look at this, I know I shouldn't be giving you guys Q&As that are advanced, but no skew. That's way too advanced, Peter, but I appreciate you because I know you're in the mentorship. So this is delta versus spot price. Uh, Delta is obviously what we hedge, right? So very simply, options are alternatives to the underlying equity. When we look at options as market makers, we are always hedging them. When you guys trade options as individuals, you probably are not going to be hedging them very often. You may treat them as static hedges for whatever your portfolio is. But most of the time, you're probably not actually thinking about them in terms of what's my hedge with the option. However, delta is still relevant because you need to know what the purpose of your option is, right? So at the first level, it's mostly going to be about replicating the equity. And in our case, almost, I would say 99% of the content I've done is about SPX. So it's not equity, it's index. For our purposes, same thing, right? So call options are the right, but not the obligation to participate in upside price movement, and put options are the opposite. So if you look at this, what's funny about this here, let's see if this works. Okay, cool. So I'm going to try drawing here. Look at the bottom here. So you have spot price down here. There we go. And you have the implication is put option delta is the red one. This is kind of smooth. Call option delta up here in the blue. But spot price, there's only one axis. So the idea here is kind of strange. This, in my opinion, should be flipped. We'll clean all this up for future iterations, but this should also produce some back and forth. Gamma effect is actually kind of embedded in here, right? So the gamma effect we'll talk about next, but very basically the idea being that an at the money option is where your straddle is, right? So right here, let's see where we're trading. I should know this. 66.10. I don't want to go too much into like current price activity, but 66.10 is where the current at the money is. So this would represent your straddle. If spot were to decline, let's imagine this red line is actually kind of like this. Okay. Spot declining is going to push any put option more and more in the money, right? And so spot increasing, like it is here, will make any call option go more and more in the money. Now, this brings me back to a very basic concept. When call options have small deltas like they do here, oftentimes you'll hear the term soft delta versus hard delta. Just know that this range here, very much like hard delta, right? And the reason for that is that you're getting very close to these delta levels that are associated with the actual underlying itself. One sec. On the flip side, you have the same exact behavior on the put side. So to the extent that the put strike goes more in the money, market sells off, the actual spot level or value of the underlying is now well above the put strike. The delta is going to approach -1, right? So same thing. This is going to be where we consider things to be kind of hard delta. This is where we consider them to be kind of soft delta. Matt Cashman, somebody who I stood next to at the CBOE, did a webinar just the other day actually and talked about the same concept. And he approached it from the concept of variance, which is interesting because if you guys think about the nature of put call parity, In effect, anytime you have an option that has 80 delta, for example, on the call side, it should be the same as a 20 delta option on the put side. It should be right here. But hard deltas don't have, or options that are deep in the money that are hedged with hard deltas or similar to hard deltas don't have as much variance in their price as the market moves. Now, what's interesting about that is there's a reason, which is kind of intuitive. It's more to do with, however, that a larger chunk of the options premium is intrinsic instead of extrinsic. So if you were to think about this in terms of maybe like the ratio of the price, the portion of the price, right? So a deep in the money option, let's just say we're trading 6,600 right now. Let's assume we're talking about the 6,000 call strike, right? The 6,000 call will have almost no extrinsic value, meaning the entirety of its premium is going to be what we call a box premium. It's just the difference between the strike price and the current spot level. The put option instead will have a very tiny premium, and it depends on what kind of tenor, and we'll talk about that in other calls. But just know that the actual option price is going to vary a lot for the deep out of the money option and less for the in the money option, but it has more to do with the fact that so much of the options price when it's deep in the money is coming from the intrinsic value, if that makes sense. Uh, we're not going to talk about vomit in this call. Sorry to get distracted with the chat. That said, so moving on to this kind of graphic on the right here. This graphic on the right illustrates it a little bit more clearly, I guess, in terms of how we expect the delta to behave moving through spot levels. So this is one of those generic ones, of course. You see these all the time in textbooks where there's this nice, pretty at the money of 100. This is going to be, oh, forgive me on the tablet here. So this is your at the money. This should intersect with 50 delta cleanly. Um, and as this option decays, which we'll talk about in a second next, but for the purpose of like moving from delta to gamma, so obviously when an option has a lot of time to maturity, a lot of its value is still kind of up for grabs in the end. The probability distribution is wide. And then when you start to move towards expiration, the options are going to come, sorry, they're going to decay into a state in which the movement of spot itself has a tremendous effect on the options delta. You can think of it as like the option is either very likely to be in the money or out of the money, and it's changing as we're moving around the strike price itself. Sorry here, no cursor. The whiteboard, I think, doesn't have a cursor for the questions here. So when you think about options and time to maturity, I think one of the next images might have this on it, but for the sake of like understanding how delta evolves, right? So when you think of a very long dated option, you're going to wind up experiencing or seeing something more like this, flat, flatten, right? And so this is something that almost has no gamma to it, or a very little bit of gamma, because the delta is always stable, right? It's changing, or the option values is stable. The closer you get to actual expiration, this begins to be tightened up around the spot level, right? And what this is saying is that shifting from one state to the other, like if we're talking about the 6,600 call again, when we're talking about zero-day options, which we talk about all the time, a $5 move, for example, might change the entire state of the option. And so now as market makers, we're always kind of hedging these, right? Using a tablet, okay. That's kind of the core of the business. And so when I talk about dealer hedging dynamics and the influence on the market, part of our assumption, and the whole reason it's even interesting for me to follow, is that I know from my experience as a market maker that this is something that is rigid. We don't treat these as like wishy-washy. We don't bet on outcomes here. We actually just hedge whatever the model gives us. If we don't, we're gambling in our parlance. So that said, the what most people get wrong when they're looking at option trading, or maybe if options trading is making an influence on the market, how do you read it? They follow flow, right? And so most people go to flow first, and they wonder how an options impact on the market happens at the hedge, at the time of hedge. But the reality is, and you guys should know this by now if you're in my ecosystem, is most of the impact on the market that we care about is not necessarily coming from the initial trade, right? That initial trade is hedged, one and done according to whatever the delta is at the time. But once that happens, um, it's all about dynamic influence, right? And there are a couple of core Greeks that actually drive the dynamic influence. Gamma is one of the most important ones. I would say charm is right up there as well. And then Vanna, which we won't talk about on this call, but is also super important. Delta, give me a second here. Or sorry, gamma, if you want to move on to another image, we swap this. Cool. There we go. Okay, cool. So gamma defines how quickly this delta changes, right? So in the image to the left that we just talked about, what it's showing you is like when that delta graph is kind of flat or has a gentle slope, there's not a lot of gamma to it. It's a smooth function. There's not a lot of predictability or like embedded kind of path in the market with respect to how that option is being hedged. When we start getting towards expiring options, these influences become massive. And that's actually probably why we talk about this so much now, is because so much of the order flow, I think 60% last time we checked, is actually 0-day options, right? So 0-day options are going to have the most gamma out of any options on the surface. Um, hopefully the SIBO doesn't make it even more complicated with like continuous expirations or half-day expirations. I don't know. But right now, though, you see this here. This is a simulation of the gamma at different strike prices. Um, what this is essentially showing you, one second here. This is obviously the implication being the strike price is 210, right? So the option here, the at the money option, is going to be 210. The days to expiration, if you step through the different parts of the legend here, uh, the flattest curve is longest time to expiration. It's almost always going to be the case that the longest time to expiration has the least gamma. So when you guys think about trade structuring, obviously, you want to factor that in, right? There's this embedded trade-off all the time, and we won't cover the trade-off in this call specifically, but you should always think about, okay, am I paying for realized volatility or am I paying for implied volatility? If you're paying for implied volatility, what you're betting on is kind of the market's assumption about volatility or about future movement, and you're buying Vega, right? If you are trying to make a bet on what's going to happen now, for example, tomorrow, great example right now ahead of the September 2025 Fed meeting. If you are betting on tomorrow's Fed meeting, having a market influence, you're going to want to have options that have this distribution here. Whereas if you think that tomorrow's action changes the nature of the vol surface going forward, maybe starts to create this blow-off top that reverses into a hard sell, you probably want a little more coverage than just tomorrow, and you actually want to have effects that are more tied to Vega than gamma or underlying movement, which is going to be this one here, right? Most days we wind up talking about this, the gamma intensive option. And this 14-day to expiration here, obviously that seems antiquated, right? For most of us here, it might even seem like a long-term option at this point because 0 days have become so prevalent. So this being 14 days, just know that a 0-day option would be basically, this is the underlying of 210 here. This would look like something ridiculously vertical around this distribution. I can't even draw it with my cursor here. But this is what we deal with every single day. And so obviously what we care about with gamma is how the market, well, two perspectives, right? I should rewind back to the Greek itself. You choose gamma because you want convexity on market movement. Okay, to be very clear. You choose Vega because you want exposure to implied volatility. You choose Gamma if you want actual convexity to market movement, high payout ratios. You want options that can perform on a market move. So that said, what that kind of is doing for you, right, is like you're replacing the equity. The trade-off is that you don't get, you wind up, as Jem likes to talk about it or mentions all the time, you kind of like you select part of the distribution that you care about. So for example, trading 6612 right now, if you wanted gamma for tomorrow, you're going to choose a direction or maybe the straddle. But if you choose an upside call, for example, you only get performance on part of the move and you only get like, through your strike, obviously. And your trade-off is it's not free, right? So you're doing a couple of things. You're eliminating your downside. So if you buy a call for tomorrow, you're eliminating your downside potential beyond whatever you paid for the call. So in a sense, if you're thinking about it through the lens of equity replacement, you're switching from stock or futures or whatever you might otherwise trade to options to cut off your downside possibility. But the flip side, you're going to be paying for this, right? You're going to be paying in terms of theta. Now, if you get a move tomorrow, there's a range against which you don't necessarily have the option performance replicating the underlying equity itself, right? So if we're talking about the 6620 call, for example, trading 6610, until that option becomes in the money at expiration, it's going to have a delta that's much less than 100, right? So you're going to wind up dealing with a sensitivity that's not maybe as high as you would otherwise have for a lot of the day. It won't be a 100 delta option until it's expiring. I know it's only 1 day to expiration. It's going to happen pretty quickly. But that's kind of the trade-off. You'll only get maybe 50 cents. Actually right now you'll get maybe like 40 cents on the dollar for a nut move. It'll evolve quickly if it's a 0 day option. And then once through the strike, it'll start to actually decay your way, which obviously brings us to our next point, which is theta, right? So the trade-off between what you kind of pay for all of this, the trade-off winds up being theta. So, second here. Okay, so I'm gonna just copy something over here really quick. Okay, here we go. So bear with me on the whiteboard here. Okay. So theta is kind of what you should understand as your cost of doing business, right? So theta is always going to be higher. Um, the higher an implied volatility is. IV is kind of like your option. It really is just your option price. We'll talk more about that on other calls, obviously, on how to read the actual IV and what it means. But just know that when you look at the 0 day straddles, for example, today's straddle not expensive. Tomorrow's straddle, let's just call it really quick. Just give me one moment here. Let's see. Okay, so today's straddle maybe $10, right? Tomorrow's straddle is gonna be multiples of this. Your theta tomorrow should be high because we have an event, right? And so if you look at this chart here, I mean, we spend so much time on this part of the distribution. It's almost funny to talk about the longer dated. There we go. Okay, so rewinding kind of back towards the Greek itself as a general thing, right? Theta, as your cost of doing business, does have a trade-off too with time. So at any given time, if you are far out on the curve, for example, if you own options that have a lot of time to decay, like here, I'm not sure if you can see my cursor actually when I'm doing this or if it just shows up on my screen. But if you're looking at 120-day options, there's almost no theta, right? And you can validate this yourself pretty easily. We have a lot of dates on the calendar. Term structure is going to cause a little bit of variance sometimes, but if you look at two options and you want to get an understanding for how small theta is as you move out on the surface, just compare calendar spreads, right? Just look far out on the surface and look at like a 1 week time spread or a few day time spread at end of October, for example, and then do the same thing for a time spread this week, right? You wind up seeing this here. You see the difference in the way the prices differentiate pretty quickly once you start to get towards this really inside of 30 days. Sorry, my mouse is being a little weird here. This is kind of the sweet spot, or this always has been. 30 days is interesting. There's a lot of activity at the 30-day point, a lot of benchmarks that kind of isolate the 30-day tenor. In the past, a lot of my career was actually spent trading options that were either kind of, we had maybe one or two expirations here. God, I sound so old. We had one or two expirations between here and 30 days, and then so much of our trading was beyond, right? So theta was really like, did you have front month options or did you have long dated options? Still the case, but for for um for all the flack that the SIBO has taken for like inducing a lot of retail trading, I think what people don't understand about what they've done as a business choice is they've actually made the market a lot safer. And to think about that just from like a hedging perspective or a quant perspective, if you only had a couple of options on the calendar to hedge your risk, you have more concentration risk. The fact that they've filled in all these dates here actually means that we have so much more ability to spread risk throughout the calendar, right? So it's a much more stable market. That said, so much of the trading right now at I think 60, literally 60% of volume is right around here at 0 days. And so you see the trade-off here, right? And if retail ever suffers, you ever hear retail suffering with options, this is why. It's this slope right here. It's how quickly the options value decays. So this slope of this curve is actually theta, right? On the left-hand side, you have the axis option value. Just understand this is an extrinsic or straddle value. The right-hand side is just the option tenor. And so as the option decays, its rate of decay would be this, like the slope of the tangent line, right? The slope of the tangent line at any given time would be the rate of decay here. And you can see that it starts out flat and then it starts to accelerate. What would make it accelerate? I'll just say this. Higher vol has higher theta. It should just make sense, right? If you take um, anything that's going to decay linearly or semi-linearly, whatever, if it has a shot clock on it, but it has a high price, the higher the price, the more premium has to come out of it. So the higher the theta. Additionally, with our, the market the way it is, you have not only this feature here where there's a decaying option value, but oftentimes too, we wind up seeing term structure effects too, where you roll down the term structure, which we'll talk about in later calls. But just know that most of our trading that we talk about or that people seem to be focused on today, the reason it's so difficult is this theta profile. Things evaporate very quickly. So it's a great question. How does theta decay work in 0 day options since we only have 6.5 hours? Um, do you mean does it work differently for 0 day options? I'll just say kind of from my market making experience, a trading day for market makers is not always the same as what you'd expect a trading day to be. Um, we have like a decay profile on our side that actually decays the option at a variable rate. If you guys think about when options or when equity volume is the highest, you're going to probably think about it in terms of like the first 30 minutes and the last 30 minutes. I think maybe some people call that volume weighted time. Um, some call it like variance weighted time. But the premise is like you want your decay profile as a market maker to actually decay things when the activity is happening, right? And so there are periods in the middle of the day, for example, where the straddle shouldn't decay much because everybody's literally at lunch. That might change. I'm actually really curious to see what happens as the option market moves to like there's all this talk about 24-hour trading. Whether you're morally for it or against it doesn't matter. What's most interesting is how the market structure will evolve to handle it. Um, It'll be very interesting. Tomorrow, for example, what you guys will notice, and I know this is getting a little bit deeper into the weeds, but just to wrap your head around how these things are not always so simple, right? There's no linear time decay tomorrow. You're going to wind up maybe even seeing the 0 day straddle increase into Powell's press conference, right? So we're obviously recording this ahead of the September 2025 Fed meeting. So what happens is like everything comes to a standstill. We actually, in some ways, you can say we don't even move time in our model until the event happens. And then when the event happens, in tomorrow's case, you'd kind of liken that to it's kind of like an economic release, whatever. These things have variance profiles associated with them. When it happens, we take out a consolidated amount of time, like a compressed amount of time comes gushing out of the straddle. Any model that's looking at it without vol time calculated this way is going to see a big vol change just by way of this decay function. But anyone in the market making space won't see their fall surface change. It's kind of funny how it works. Theta time is continuous, but it's how should I say this? It varies. Like the it's not quite discrete. It's not like we're iteratively taking out a chunk of time, although it is kind of like that around events. When you decay the event variance out, it is very much like a discrete decay issue. And you'll see that every single time. For example, we talk about this a lot in front of NFPs, CPI. The next NFP is probably going to be a big one because right now the market's kind of really focused on whether we're cutting rates into a recession or we're cutting rates just because, you know. And the difference is actually a pretty big deal. So I think probably you'll see this next. If you're looking at this, I would encourage you guys to look at the 0-day straddle um, October 3rd at 8:25 in the morning Eastern, and then again at 8:35 in the morning Eastern. And just know that from our perspective as market makers, that is really just decay. But this is getting a little bit deep in the weeds, obviously. This is more like mentorship material, Discord material. We have these conversations all the time in Discord. I know a lot of you guys are in the Discord, but this is why we do the morning meetings all the time to get into these like kind of, tangents that are really, really helpful if you're an active trader. Yeah, there are moments I would say too to this question. In terms of asking whether time will decay at varying rates, it's totally fair to say yes. There are periods in which like our decay will slow down because we don't expect any volume to happen. And then our decay may speed up and moments like, I mean, think about the last 15 minutes of expiration, right? The last like $3, $4, $5 of the straddle has to come out in 10 minutes. That's extreme. That's not as fast as the rest of the date, right? Exactly. So this question here says, so you mean that the price is not kept quote unquote stable by increasing the IV as time passes, but instead the model keeps the IV stable by not discounting the time, and then after the event subtracts just a bucket of time. Yes, it's almost like we have um, a modified time function. Exactly what you're kind of alluding to there. A lot of confusion about that, obviously, I think on the retail side, because we see a lot of effects. For example, everyone thinks there's a VIX effect on the weekends, but there's not a VIX effect on the weekends. It's not like vol suddenly changes because a weekend happened. A weekend is not a vol event, nor is a new week. But what does happen is the model that everybody looks at uses calendar days, whereas the model everybody uses trading days, and they're not the same. And so in our models at work, when we're market making, we close on Friday, we open on Sunday night, and there's been no time change, right? But if you look at what happens to the VIX suddenly says, given this set of options at this implied value or implied volatility, which you have to back into, right? You back into the IV by taking the option price and all the other knowables to get the IV. But when you compare what we've done on the market making side, which literally from Friday night to Sunday evening, time hasn't changed. We maybe passed a minute from close to open in our model, whereas the VIX calculation passes 2 days. And so you have the same option with the same price, holding flows constant or whatever. But the naive model says, oh, shoot, this option has a lot less time to expiration than it did last time I evaluated it. The vol is much higher. And that's why this effect happens. The question of time gets a lot of people tripped up in this. This one is not for a sneak peek of the new platform. Sorry, I'm addressing all the questions because I like to do back and forth. But there will be sneak peeks of the platform when it's available. We're working hard on getting it out. We also want to make sure it's stable before we start letting people beta test it. So we're just wrapping up details here. And then, of course, this will be recorded and available after the Zoom. Okay, cool. Okay, so um, let's see here. What else do we have as far as bases to cover? Yeah, so this is mostly supposed to be about like a bottom-up approach to the Greeks themselves. Um, we focus on these Greeks because of my experience market making. I know that these things are hedged and that the hedging actually produces influence in the market, right? And so the uh, the kind of suite of things we're doing is very much focused on market intelligence. The platform is going to be an extension of this. I will say, what drove me to do a lot of what I'm doing now was really I enjoyed my career as a market maker up until the point where it became very, very systematic. And then I kind of had a gear change where it was like, you know what? When it becomes too systematic, you almost want to be on the other side of it, knowing how it works. And I think that's been increasingly entrenched. And you can see the fascination with these flows. The CBOE has kind of really doubled down on chasing volume. I don't think they're doing anything wrong, obviously. I think they're actually pretty smart in what they're doing, and they're doing a lot for investor education too. But you can see the markets are increasingly mechanical, increasingly hedge driven. And so I think understanding these basic concepts is super important because everything we talk about now, like for example, theta, the trade-off between theta and gamma, all this stuff is influential and it drives the market making business decision too. So of course it's going to drive your own spread selection, but it also works from our perspective because we're trying to avoid risk as market makers all the time. Uh, it might not seem that way to you guys because there's a lot of misconceptions out there too that market makers are manipulative somehow, or they are, perhaps maybe obviously robbing every retailer of their put premium. But all these types of misconceptions, once you actually understand the processes, and the processes involve first the Greeks, like understand what the Greeks are and why they're hedged and how they change. And then the business and market making, you understand that really the management of the Greeks creates outcomes that look manipulative, but in fact, a lot of times, and a lot of guys who I can see here in the Discord and morning meetings, they actually create outcomes that are like adversely selected for market makers. So we wind up having like instances where everything we're doing produces a single outcome that doesn't really favor us. But the point is, it's risk minimizing. Exactly. It's literally the natural consequence of the hedging process. So all the stuff out there about market makers stealing your money, completely BS. Um, it's just a natural process of hedging. So the question about the data platform, this is obviously not about the data product, but the point is, I started doing vol signals because I didn't really want to leave market making, but I didn't know how to adapt what I loved about it to something else. Um, Going into the public sphere became obvious too, you lose your tools, right? So you go into the public sphere and all of a sudden you don't have what you're used to. And you also realize that everybody else is completely backwards on what they're doing, right? So when I left my career at Belvedere, um, two things clicked. Need better tools, and everybody has everything wrong, right? And so that's kind of what has gotten us to where we are today. I think there's been a lot of improvement. I think we have come to this domain too to kind of steer that improvement, for lack of a better term. A lot of firms that were in the space before are doing a much better job now, and I hope that that's partially because of me being so vocal about some of the things that were really just not knowable. I don't say that lightly. Like I wouldn't know the half of anything you guys do in your jobs, so I understand completely that a lot of this stuff is just not knowable. But the point of the data platform is to distill all this to a very intuitive level for everybody, in a way that I can say makes sense. Do market makers hedge constantly? Very different for every market making group. Great question, by the way, and I think it's a valid question. But even just very practically, like how could everyone hedge constantly? You can't do it, right? So we try to simulate continuous hedging, but you can't do it. So you wind up choosing things, and there are trade-offs in how you choose. Some firms might have really, really sophisticated ways of doing it. Obviously, the more you can internalize, the better, right? Because the less you trade into the open market, the more you can internalize, meaning cross within your own firm, the better you can do. And I think that's why you see a lot of this like multi-strat type of thing pop up because there's a lot of benefit to the business to actually not trade at all, just to kind of like cross the bid ask internally and keep your transaction out of the market. That said, as far as the question of hedging constantly, like there's ways to hedge. It of course depends on your position. It depends on your strategy. It depends on what your technical prowess is. There are firms, and again, this is why I think this stuff is so interesting. There are firms that are very, very rigid. If you are competing entirely on speed, which I think most like high frequency type desks are, you imagine you have to have a pretty efficient hedging process that's to fire off instructions without any kind of delay on the hardware side. That's not very easy to change on the fly. So a lot of that is, constantly hedge. Um, One second. The But like the desk by desk, like when we look at the overall position every day and talk about it, what you're looking at is a net, right? And so I want to make that very clear. You're talking about a net process, and there's variability among how everybody does it, and there's a ton of entities doing it. So Don't assume it's one rule for everybody. So I said that everybody was doing it wrong. I don't think everybody is doing it wrong anymore. I do think that there are some things that are clearly not, there are a lot of things I know from my experience. It might be about which positions you should include in certain portfolios, right? I know, for example, that there are certain positions that wind up needing hedges and some that maybe wind up not being hedged at all. So that being the case, there's position construction for one. There's modeling. There's quirks with modeling where maybe the model that's generating the profile is not exactly what I would be using at my desk, but that creates situations where it's mostly okay, and then sometimes it's really, really wrong. There are also situations in where maybe you need to have more up-to-date information than you do anywhere right now. So, knowing from my experience, it's obvious if I sit down, I can look at one thing versus the next and say, okay, that's important, that's important. Um, I don't want to state them all, obviously, but I think you get the idea. So another great question. A lot of platforms focus on flow or dealer positioning. What will be different about your platform that's important to market making? You say important to MM. Obviously, I assume you mean market making. The point that I would make is that so focusing on flow and positioning, nothing wrong with that. We're going to focus on positioning first because I believe that flow is unpredictable, right? So I think there's a certain amount of information you get from flow from single name equities, which is great. I think we'll probably wind up discovering a lot of cool things as we work through like developing our index niche first. But for the most part, what I like about dealer hedging flows is that it is predictable. There is a way to discern information that is like relatively rigid. And I know from experience that like, you don't get away with carrying risk naked. And so these things have to be hedged. So for that reason, I like the dealer hedging flow angle because of the amount of precision you can get there, the accuracy and precision. Doesn't give you the answer all the time, but it gives you a major, major tell about the imbalance of participants behind the scenes. So Dr. Chan, I'm not trying to badmouth anybody, obviously, but every platform has their own limitations. What I would recommend too is like if you're using a platform, don't get caught up on everything I'm saying. If something is working for you, never change it, right? May as well it stops working. Or until you can put it in the, compartmentalized box and think about the next thing without actually ruining whatever edge you might have. That said, for example, Spot Gamma's been making a lot of changes. I don't know what Quant Data does for their platform. Unusual Whales is making improvements. Options Depth, for example, came out with a method of dealer position construction that I know is more accurate than what was being done at the time. A major step up, and then everybody had to follow that, right? And so a lot of these guys have come to the table to do things that way because it's the correct way. The open interest way, the naive construction way just doesn't work. The inference model, like when people talk about you know, the idea of taking whether a trade happens closer to the bid or the ask and saying it was a buy or a sell because of that, like that has a lot of limitations. I promise you, if you do that on some of the bigger names, you can get a lot of stuff wrong, just by the way the market actually prices. And so that kind of stuff winds up creating some backwards things. You probably seen me do some commentary on X before with like cheddar flow, for example. Um, I think low-hanging fruit for improvement there. Dark pool data integrations, that's not on the table right now. And I say that because I don't have any experience in my own capacity where that was a big part of our hedging process. We had a delta desk that internalized things, but for our purposes, running the actual mo option model, it wasn't clear exactly whether there was any kind of edge there. Um, Nothing more to really say there. Retail ES trader. Um, any notes, paper, specific concepts to know? I'd appreciate papers I could look on PDFs. So I'm not quite exactly sure what you're talking about. If you're saying you're an ES futures trader, I would just say that listen to some of the other spaces calls I've done, webinars I've done. We'll do more. We'll also probably redo maybe this one to improve upon it. But the point is the options profile, when I talk about the hedging influences, what we get is a prescription and a and then obviously like there's some conditionals, right? So we like to talk about in terms of like the options profile gives you a prescription, and then if there's any kind of signal or way to interpret other flow around it, that's super valuable. Sometimes the profile itself gives you directional signals, not all the time. But to the extent it does, for a retail ES trader, if you're talking about being a futures trader, it gives you information about direction a lot of the time, not all the time. but even more importantly, gives you information about maybe expected moves. So if you're looking at something from perspective of like, okay, where I think we should go along here, but where should we stop? Some people use volume profiles, some people use other things. The options profile to me is very, very robust in this particular domain too, because I can look at a position and within, 10 seconds tell you where we should stop if we move in that direction or slow down. This is a great question. Is there statistically speaking, is there a sweet spot in terms of duration for an options trade example, 30 days, 100 days? It just depends on what you want. And so we talk about this in the mentorship. We'll have another one of these webinars with Matt from UBS because he's spent a lot more time managing longer dated positions. But the point is there are trade-offs, right? So if you go farther out on the surface, you're into vega and implied vol effects, and then closer to the money, you're into gamma and realized volatility. So the trade-off then becomes, okay, how much do you want to spend? How much gamma do you want, like coverage for current movement versus later movement? And how much risk do you want in terms of how the market prices vol? So the sweet spot really depends on your needs, I would say. Uh, Polos will be ordered and sent to the mentorship guys, but we'll probably put up we'll put up a store or something. Um, the question about the platform being SPX ES related in the beginning, yes. Great question about options. Just to be clear, did zero-day options become more popular during COVID? And once they started to get more and more trading volume, how our processes changed? That is a concept for a Spaces call. That is a huge loaded question. The answer is yes to all your things, all your wildest guesses there. It changed everything. What I'm most shocked about the COVID period is that they didn't shut the floor down. So every time I see these, clips of people on the trading floor, I'm shocked they didn't shut the floor down because they had an opportunity to shut the floor down. And just as an aside, when I was on the floor as a market maker, like I was told that they'd shut the floor down. So anyways, I'm gonna wrap it up here. So, for our purposes, we have a mentorship call in 10 minutes. If you guys want the answers to all these these deeper questions that you guys are starting to get into, that's mentorship material, obviously. So, there's no holy grail. There's no perfect solution to any of these questions, obviously. But you learn a lot on the vol side as a market maker and as a vol trader. So the mentorship, the purpose of that is to have somebody who ran New York, like, big desk vol type stuff. That's huge, right? And then the stuff that I talk about from a market making perspective is the other side of that. And so bringing that together for trade structuring, but market influence at the same time, huge value add. And we're going to do a call in about 10 minutes to cover some of those things. And then again throughout this week and next. So the website probably has information on that. The data platform, a couple of other points too. So the mentorship is over, it's complicated. Somebody actually brought up in the last thing, if it's too complicated or if it's over your head, Vol Studies is a place to go for things that are more basic. There's a great book. I always recommend to people a couple of books. Natenberg's Option Pricing and Volatility, or I might get those backwards, but his book was like literally the book that we started out with in the industry when we started trading. Uh, Alternative to that, the next level is kind of what we call, there's a book called Trading Volatility by Colin Bennett. Great books. Vol Studies, the purpose of that is because this was a book that we literally like day one, you have to master this book before you trade. Before you get to the next level in your trade, your trader trainee process, whatever. So that book is kind of like it's a little bit dated, but I go through it with people to kind of cover the material from the ground up. So it's much more theoretical, but trying to bridge the gap between theory and practice, obviously. The mentorship is more about tactical trading. So more experienced traders, perfect for that. And then just to kind of round it out too, a lot of you guys are already in the Discord, but if you're not, the reason for the Discord is to go through this every day, right? We used to have this all the time at work. And what I actually do miss was good morning meetings. So every single day we do like a morning meeting. It was kind of like a pre-market huddle. The idea at the time was, okay, you have a team of people. So market making is an entire team of people. You start out by getting in a group, talking about your position, market, what the market's doing, what like trends and flow, and also what to expect. We've kind of just tried to replicate that in the Discord every morning for that particular purpose because I don't think this stuff is easy. I sometimes am very impressed with people that get this quickly because I spent, 15 years basically doing this every day, 24/7, and then going to bed thinking about it. And so I respect the idea that it takes a lot of repetition, and I try to deliver as much of that as possible in the Discord every single morning, and more of it. And actually, we're building some pretty cool pricing tools too. So a lot of you guys in here who are already there, just stay tuned because you'll see over the next week, we're gonna add things like charting option Greeks, for example, getting historical polls of option data. I think will be a lot more native to the platform in Discord, and that should be very, very helpful. Um, don't worry about scope creep. That's my fault. It's a I can't help it, so it is what it is. And then obviously, for any of you guys too who are looking for like more active trading, it's RTM. So we'll do more webinars on what RTM is. It's options adjacent, I would say. It's institutional flow signals. I know some of you guys who are institutional in here probably know what we're talking about, which domain. It's um, it's not necessarily market making, but it's very close. So it's stuff that gives you good directional influence, good directional tells, great for futures trading. And then we use the options profile to kind of round that out. Discord service costs. I should know this off the top of my head, but I have to think about it. I think it's $130 a month maybe right now. Can't remember exactly. Yep, thank you. Appreciate that. 130 a month. Third book I mentioned. I did not mention three books, but that's a great question. I do have a third book in mind, but it's way too complicated. Um, Great teaser. I think I mentioned vol studies. So vol studies is like what I actually do walking through the textbook. But if there's a third book, I would actually say I would direct you to Taleb. I like to explain this as like Natenberg is your primer, trading volatility is your introduction to the real world of vol trading and book management. And then yes, dynamic hedging is like where you go to kind of trip out on ridiculous um, next level thought experiments about how to get really, really hurt market making. I don't know how else to put it, but it's a fun read. But it's one of those books where if you take it up without any experience trading, you're just gonna lose your mind and be asking me questions all the time in the Discord, which is fine. Yeah, these are good. These are good covers. These books cover the basics. Link to the Discord is a great question. So the definitely need assistance on here to do this kind of stuff. There we go. That's the link. Doesn't work without the HTTPS. Anyways, you can figure it out. Um, yeah, cool. Thank you. Okay. I'm gonna close here. Thank you guys for entertaining this, obviously. This will be the first of many. The topics and the cadence are on the website. We'll improve these over time. Today was hectic. We'll stay more on topic and also tackle some more deeper subject material as we evolve. And certainly we'll use this platform to do a better like deep dive walkthrough of the platform when it's available, all this stuff. Cool. Thank you guys. Appreciate your time.